If you put money into your own retirement plan, so you're going around or outside of your employer, maybe your employer doesn't offer a 401k or any type of retirement plan, but you want to save up for retirement anyway. You can put money into an individual retirement arrangement or IRA. So IRA belongs to you, and if you change jobs, it doesn't matter. The bank doesn't care. It's between you and the bank, or you and the insurance company, or you and your brokerage, and it has nothing to do with your employer. Traditional IRA is, again, you put money in, but because it's not subtracted off of your W-2, you do see that deduction somewhere on your tax return. So if you put money into an IRA, let's say you put $5,000 into your IRA, you get to deduct $5,000. And that deduction shows up on Schedule 1, Part 2, IRA deduction right here, line 20. If you put money into a Roth IRA, there's no immediate benefit. The benefit is that it grows tax-free and you don't pay tax again on it in the future. One nice thing about IRAs is that you can make a retroactive contribution to your IRA up until the due date of your tax return. So our 2024 tax returns will be due April 15th, 2025. You still have until next April to retroactively make a 2024 contribution. So that means you can actually do your tax return, figure out how much benefit you might get for putting in various amounts into your IRA, and make a decision based on what kind of tax benefit you expect. So if you do make a contribution to your IRA between January 1st and April 15th, then your IRA custodian is going to ask, well, do you mean it for this year or do you mean it for the previous year? The contribution limits are quite a bit smaller, though, for an individual retirement arrangement rather than employer-sponsored retirement plan. And it is right now $6,500, whereas the 401k was like $22,500. This is only $6,500. But you get an extra $1,000 if you're age 50 or older. It's also limited to your total taxable compensation during the year. Compensation is just another way of saying earned income. Technically, compensation also includes taxable alimony, but we hardly ever see taxable alimony anymore, so we don't have to worry about that. So if you work part-time and made $4,500 last year, then that's your limit. You can't put more than $4,500 into some type of IRA. If your kid gets a job part-time, they make $4,000 at their part-time job over the summer, well, they can contribute $4,000 to a Roth IRA on behalf of that child. And then that can grow for retirement tax-free over their entire lifetime. An extra 50 years of growth might turn out to be worth a few cents. Another special benefit of IRAs is if you and your spouse are filing jointly, you can contribute to an IRA on behalf of a non-working spouse. So if your spouse does not work, normally their contribution limit would be zero because they have no earned income. But if you file a joint return with that spouse, you can contribute up to the maximum for each spouse. So if I were married and I were the only worker, and we're both under 50, I can contribute $6,500 for myself, and I can contribute another $6,500 to my wife's IRA, even though she's not working. And again, if we're 50 or older, we get an extra $1,000 for each of us. The rules changed in 2020. There used to be an age limit after which you were no longer allowed to contribute to an IRA. It's no longer the case, so it doesn't matter how old you are. You can be 100 years old, and if you're working, you can still put money into an IRA. So the IRA deduction is the whole point of having a traditional IRA. And however, if you're covered by a retirement plan through your employer, your IRA deduction may be limited. So we're going to see, when we look at the W-2, if there's a check in this box where it says retirement plan down here, then that means you were covered by a retirement plan through your employer. And the result of that is that if your income is over a certain limit, then your IRA deduction may be limited. You're still allowed to contribute to a traditional IRA, just your deduction is limited. It's based on your something called modified adjusted gross income, which means something different depending on what context you're talking about it in. It usually just means like your adjusted gross income, because your IRA deduction is an adjustment. Normally your adjusted gross income would include the deduction for the IRA. Well, that would be a circular definition if we're going to use that here. So basically, modified adjusted gross income means your adjusted gross income ignoring any possible IRA deduction. And the limits here are on page 178. This is if you're covered by a retirement plan at work, that is, the middle box on your W-2, box 13 is checked, and your income is over these limits, then your IRA deduction is reduced or eliminated, depending on how high your income is. On the very next page, we're going to talk about if your spouse is covered by a retirement plan at work, but you're not, your IRA deduction may again be reduced or eliminated. But the income limits are much, much higher. And finally, if neither you nor your spouse are covered by a retirement plan at work, then you always get the full IRA deduction. So if you're working somewhere and you make $300,000, but for some reason they don't offer any type of retirement plan, doesn't matter what your income is, you can contribute to your and your spouse's traditional IRA and deduct the full amount. Once again, that doesn't say that you're not allowed to contribute, it just means you're not allowed to deduct your full contributions. In that case, you're going to end up with non-deductible contributions into your IRA, which means that in order to avoid paying taxes on it twice, remember the whole idea of an IRA is you haven't paid tax on any of it yet, and you're going to pay tax on all of it when you withdraw it. If you have non-deductible contributions to your IRA, then you have to keep track of all of the non-deductible contributions you've ever made throughout your entire lifetime in order to, when you draw it out, not pay taxes a second time, which is kept track of on a Form 8606 and is a headache. It's enough of a headache that I always recommend to people never ever do this. Because if you do and you forget anytime between now and retirement and you lose this form and you stop keeping track, then you're back to square zero and you're going to be double taxed on all the money you've put into your IRA without being able to deduct it. All of your non-deductible contributions. I wouldn't even trust myself. Remember when I turned 80 that I still had those non-deductible contributions from my 30s. And then you might even think, well, I got a tax guy who'll take care of that. Well, is your tax guy still going to be doing taxes 50 years from now when you're ready to retire? It's going to be a different person. Who knows? Is all the paperwork going to be moved correctly from one preparer to another? Probably not. Like for things that like maybe 5 or 10 years in the future, I might say, yeah, it's going to be the same guy. I trust him to keep track of that. But an unforeseeable amount of years in the future, like if I'm 25 and starting to make these contributions, I don't know who's going to be doing my taxes when I'm 75. It's probably not going to be the same guy because that guy's going to be retired. So I would recommend not ever doing that.